Let me also welcome Mayuresh Joshi on the show. Hi, Mayuresh. Good afternoon. Good to speak. Good to be speaking with you. Mayuresh, talking about the weakness in the emerging markets, yes, India too is participating in that. But in contrast, look at the move in European markets, Mayuresh. I'm intrigued to know that is this a time to maybe look at to some of the Indian players who have good exposure in the European markets, because today, of course, we have some of these reports who are still liking European markets. They're saying that the tariff risk is quite manageable. There's a positive read-through with the Ukraine ceasefire. Help us with your take and understanding on the same.
Afternoon, Shrishti. No, I think that seems to be a strong case. We have been speaking to a few companies who have seen some element of traction getting built in as far as the European clients are concerned. And therefore, there is traction across sectors as these clients have witnessed, whether it's steel, whether it's cement, or whether it's core engineering, which probably needs those niche applications to be serviced. And therefore, I think parts of Europe coming back very, very strongly as far as demand is concerned. Again, what probably happens in terms of both China plus one, and if Trump probably slaps in more tariffs coming through, I think they would be looking towards the east. And obviously, I think there is a huge element of scope that can come through in terms of plugging these gaps as well. And therefore, our read through with a few companies that we've spoken to who cater to Europe zone as an area, Srishti, I think there are positive green shoots that are being seen as we speak. And it's not just restricted to one sector. I think 3 or 4 sectors are probably opening up as we speak.
Can you flag off those 3 to 4 sectors for us?
So as I said, cement, some element of steel, and you're probably even looking at some textiles.
IT?
Partially, yes. But I think the impact might not be felt as much as you look at what the rhetoric has been when it comes to H-1B visa per se. I think that seems to be on track, that there might not be any tweaks as far as this policy is concerned. And therefore, I think the large element which probably took place in Trump's first term as far as outsourcing costs or jump up. Obviously, the demand and the IT spread that you probably see large IT companies with their large cap mid caps from their international skew. I think a large part of the.
I'll just come to you in a second. We've got you on a bad audio line. But yeah, look at the European markets. They're on a tear right now. You've got the DAX holding up about 200 points right now. Stock 600 as well, mildly higher. FTSE MIB in ship shape. Although the US pre-market rates are not indicating much of an upside, but these are early days yet. Let's see where they actually transpire. Of course, it's Hong Kong, which has been the strongest of the lot. Not today, but in the last 1 to 3 odd months, Hong Kong has been one of the key outperforming markets. Kunal, stack up a Dow as well as a Hong Kong for us. Dow, because that's clearly the go-to market, has been the favorite, and HK seems like a more tactical trade of sorts. What's your reading?
Yeah, I believe Hong Kong charts are looking very interesting. So, there was this scare in September, with that money's moving from India towards China and, Hong Kong. And those indices, they had seen a shoot up of almost 20-30% in a matter of few days. Post that, what we saw was that many of these indices, Hong Kong as well as China, Shanghai specifically, these indices had come back towards a 30% retracement. So, for example, if these indices that run up 20-25%, then you saw these indices scaling back by a margin of 7-8% broadly. Now, what we've seen coming back start of 2025 is that these indices have come back towards challenging their 2024 highs. That, I believe, could be a very big trade, and that's why I think I would sense that we could probably expect that we are into a different kind of a market scenario where global markets have been doing extremely well. I was looking at the chart sometime back. For DAX, CAC, I think FTSE is the only index which is slightly lower, or CAC is the only index which is slightly lower in the European indices. But FTSE as well as DAX, they are significantly above their previous highs. Dow Jones has scaled up almost 2,500 points in this start of this calendar year 2025 from 42,500 levels thereabouts towards 44,500. Where we are trading right now. So I think except for India and maybe just about 1 or 2 markets like Brazil, etc., we've actually seen class outperformance from coming back into many of these global indices. So this happens when there is a shift in terms of asset allocation, etc., within indices or within sectors. But then eventually, once that settles into, you see a roaring bull market coming back into the rest of the world, and that I believe eventually should trickle back into our markets also.
All right, that's the take on some of these global markets. But other than that, today back home, what we are seeing is that Swiggy is holding on to strong gains of almost a 7%. But in contrast to that, look at the move in Zomato. That's quite subdued. But Naresh, if I ask you to choose one amongst these, which one will that be? Given the fact that the earnings were not that great from both of these companies, and both have actually seen quite a correction from those higher levels. But after that, which one is looking more attractive to you right now? I believe that for Swiggy, the data history will be quite limited, but just looking at the charts, what your take?
So the simple rule that if we stay below the IPO or the listing day prices, it becomes a negative. So Swiggy just goes out of the picture. So if you go to look at Zomato, after listing, when it went off below 130, it became a problem zone. So for now, we have enough history, and so Zomato could be interesting when it goes anywhere closer to 180, 200. Because if we go back to the listing times, the stock had traded max at a high of 170. So that was back in 2021. So it's getting into an attractive point if it goes into that 180, 200 band. So it looks more interesting irrespective of Swiggy.
Okay, that's that on Zomato right now. Mayuresh, what is it that you've been buying, if at all, in this decline?
Aisha, we've been very, very selective, I think. As a space, agrochemicals looks a tad bit more attractive. And therefore, we are focusing more in terms of domestic-facing sectors. For agrochemicals, I think a tailwind coming through in terms of a good Rabi season. Expectations of La Nina conditions evolving will mean a good monsoon as we head into the Kharif season in the next few months, leading to a better Rabi season in the coming year as well. I think this space might continue doing well. Volume growth should be reasonable. Market prices have been holding. Input costs have largely been stable, specifically nitric and phosphoric acid. And these companies have indulged into backward integration, which probably means that earnings and EPS ratings, as we see it in MarketSmith India, should probably be for the better in the next few quarters as well, and hold up as far as earnings is concerned compared to the broader market. So Coromandel International, as an example, is something that we continue liking at this juncture. Based on the fact of all these factors put together, margins are held up pretty well, and expectations of stability in margins expected to continue. The other space, Aisha, that our belief is hospitals as a space should continue doing reasonably well. The expectations in terms of bed additions, which have happened in the last few months and last few quarters, should start playing more meaningful. Obviously, I think the patient occupancy come off lower with more bed additions happening. But a large part of these bed additions have happened in a very asset-light mode, more managed properties or managed hospitals coming their way. And therefore, you should probably look at the debt equity skew a few quarters back and how they are placed right now. Relatively better, and most parameters like an average revenue per operating bed, average length of stay, should stabilize, giving us the belief that earnings for this sector also should. So something like Krishna Institute of Medical Sciences, KIMS, or Max Healthcare might actually continue doing well based on the EPS ratings that we see now.
All right, so continue to like some of these hospital names and Coromandel International. But Mayuresh, did you look at some of the earning candidates, and especially from the likes of Nykaa as well as Honasa? Because what we have seen is that post the earnings, the investors seem to be liking the numbers, and especially for Honasa consumers. Look at the move today on an intraday basis, it's a 13% jump. Mayuresh, post the earnings and the commentary, which was indeed on the positive side, and some of these concerns related to inventory and the kind of disturbances even Honasa had with the trade channels, after those measures being taken, do you like any of these stocks?
So I think they both have given decent numbers, Shrishti, frankly. And again, I think the entire recovery or re-rating will depend on two things. One, in terms of the product mix, how is that evolving over the next few quarters, and whether pricing probably holds up amidst all the competition that we have probably seen. And the second element, again, I think they are coming off their 52-week low. So I think they had hit rock bottom as far as earnings were concerned. So if earnings sustain and they probably improve going forward, then the biggest enabler and tailwind will be the tax cuts, which will probably happen, which will start playing out from the first quarter of the next financial year. If this starts coming out in terms of discretionary spending coming back on track as we head into the first half, I think these plays, both Nika as well as Honasa, I think become something of choice in terms of better discretionary spending that reflected on volumes as well as forward lookers as well. So they've done well for this quarter. The street would ideally like to see what happens next. At this juncture, at our rate.
Okay, that's the take coming in on Honasa right now. Time to get in some BTST ideas as well. While it's status quo on the index per se from the last half an hour. Kunal, what about individual stocks?
Well, I'll go with two buy calls. The first one is about an SBI card, something which I recommend in the morning. So, maintain an extension for that, revising the targets higher to 900. This, is a very strong and a classic breakout for SBI cards. Excellent volumes over the last 2 days specifically. So, targets of 900. Stop loss could be trailed to 830. And the second is about an SBI Life. That's a chart which is making a very strong comeback. So from a point when the stock was significantly below its 200 moving averages, we're starting to see some degree of relative outperformance with respect to peers. Would look out for targets in the range of 1520, stop loss at 1450.
All right, that's the trading call coming in from Kunal. But Naresh, what about you?
So first would be a defensive buy on Cipla. The stock is making a range breakout of the last 2 weeks. Stop loss at 1465, target price of 1500. Second is a sell on emphasis. The stock has broken down and has been showing negative momentum for the last 3 sessions. Could continue for a couple of more sessions. Stop loss at 2630, target price of 2550.
All right, that's the call coming in from Naresh. One buy and one sell at this point in time. Well, let's move on. Let's also hear out from Rajiv Batra, who is the head of India, Asian and APAC, ex-Japan and China equity strategist at JP Morgan, as he shares a list of sectors and spaces where he finds value. Listen in.
We upgraded post-budget consumer discretionary ex passenger vehicle overall, and we, you can say, booked profit or neutralize our overweight on industrial sector. That made us overweight now on financials, consumer staples, consumer discretionary ex passenger vehicle, healthcare, and real estate. How we are funding it this through? We are underweight on energy sector. We are underweight on material sector. We are underweight on passenger vehicle, or largely you can say auto. And we are neutral on energy, but with more, you can say, a kind of a negative deviations to the benchmark based on our portfolio allocation. So you can say marginally negative. The reason behind this, if the things are getting bit stable or selective on the capex side, your commodities will take a hit. And knowing the neighboring country, China, where they also are willing to grow this year more through consumption rather than fixed asset investment or a trade pattern, then definitely it is not a great news for the commodity space. So that makes us a bit bearish on the commodity side. On passenger vehicle, again, if the demand is coming back in urban areas overall, it is not going to be on the high-end basis or even on the mid-end. It will be on a low-ticket discretionary item. So that will be supportive at max on the two-wheeler side. The pivot or tilt that has made on the consumption side, that will again get the belief of foreign investor back that India is again supporting the consumption story. Knowing that into account, once the dust settles, people will make a comeback again in the same old spaces like financials, IT, and your consumer. Large cap as a bucket, you will see, is more biased, or you can say more heavyweights on this particular 3 sector, whereas your mid and small caps were more like edged on your industrial, capex, or manufacturing related story.
Okay, that's the take coming in on the markets right now, which are pretty quiet. It's, of course, Muthoot Finance holding out very well. SBI Cards has perked up very nicely. About a 5.6% uptick is what you've seen on SBI Cards. In fact, there was a Macquarie upgrade as well, wherein they upgraded the stock to an outperform from the earlier neutral. They raised the target price as well, all the way to 1,000 rupees. They're saying that channel checks are indicating that credit card slippages are now plateauing out, and that expect credit costs to start declining materially in the next 2 quarters or so. Mayuresh, is this a space or an ancillary of discretionary spend that you would look at, SBI Cards perhaps?
Well, not really at this juncture, because I think it's evolving, right? Because a large part of the asset pool in terms of unsecured lending that's priced under. Because yeah, it cuts are going to probably get delayed and deferred after what.
Naresh, we'll try to get you back on a good line, but back to the markets. What we are seeing is that a little bit of tick of reds coming in for Nifty as well as Bank Nifty. But look at the moves in some of these metal pack. We just discussed some of these metal names, and definitely what we have seen is that some of these reports are also highlighting that there could be some tariffs on the imports of steel coming in from China, and that India could imply with. But other than that, definitely Godrej Properties is another stock from the real estate pack that has done pretty well for itself. Ipca Labs too on the back of its earnings, a 4% jump there, and stocks like NHPC and SAIL are also holding up quite strongly. But Kunal, PFC was another counter that was one of those movers in trade on the back of the earnings. Any take and any BTST trade here?
So yeah, I think not BTST trade, but I think PFC could be a very interesting bet. So I strongly believe that both PFC as well as RSC, I think these stocks had done exceptionally well in 2024, and now these stocks have corrected almost 40% or more than that from their 2024 highs. I think PFC was a stock which was almost at 585 to 600 kind of a zone. Mid of 2024, and from there the stock has come sub 400 levels, and that's a very sharp correction for a stock like PFC. And then very recently what these stocks have also shown, they've shown that these stocks are forming multiple times when the stocks have formed a low, but then the RSI has actually made a higher low. So that's what we call as classical bullish RSI divergence setup. With yesterday's move from PFC as well as RSC, I think these stocks have formed a bullish doji kind of a formation. So my expectation is that if this recent low gets protected for both of these names, you could expect that these stocks would fairly do well, but not exactly a BTST kind of a trade.
All right, that's the take coming in on PFC. Could be an interesting bet, but not a BTST idea. But tell you what, it's a ET Now news break that has been confirmed as RBI meets NBFCs. And just a while back, our colleague Anjali got you the news flow. And this is a confirmation that we are getting that RBI did meet select NBFCs and industry representative. And in that meeting, RBI Governor Sanjay Malhotra, Deputy Governors were also present. And RBI did stress upon balancing the growth aspiration with sound practices. RBI did say NBFCs to ensure fair treatment to the customers, and they have urged NBFCs to become part of the Unified Lending Interface, that is ULI. And it's the first meeting actually between the MDs and CEOs of NBFCs with the new RBI governor. That's the take we are getting from the sources, that the meeting has already been done, and not just the NBFCs, some of the select companies from housing finance as well as microfinance institutions were also present, and executive directors in charge of the regulation, supervision and financial inclusions were also present in this particular meeting. So that's a confirmation on that ET Now news break. But definitely just a few minutes left as we wrap this today's trading session, but can't say that it was a great session indeed, because the start looked very well. We were holding on to good gains towards the half a session did went by with holding on to good gains on the benchmark indices, but in the second half we once again see that selling pressure trickling in. But at least for today, 23,000 is what we have defended. But Kunal, your last take and last call on the Nifty 50, how do you see the closing?
I think, of course, the closing is on the much weaker side than what it was, at least in the mid part of the session. But then I think we've gone through this phase of volatility for the last many days. So my expectation is that what we need to see is that whether the index holds on to the previous day's lows for 3 consecutive trading sessions. If that happens, then we can expect that the markets are building into a gradual recovery phase. The only concern for the markets right now is that without any kind of an events lined up, the India VIX is still at 15 to 15.5 odd zone. That's keeping the market into a lot of choppiness of volatility. So I think once we see the India VIX cooling off back again to the 14 mark or sub 13 levels, that's where I would believe that our markets and the volatility what you're seeing today, that should stabilize.
But Aisha, tomorrow is Valentine's Day, and I'm sure you don't want to see that red color, right?
Well, Valentine's Day or not, I don't think any of us ever want to see red.
Exactly.
I don't think you need Valentine's for that. But yeah.